Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is February 27th, 2025. Good morning, everyone. I hope you're all having a fantastic start to your day and are ready to dive deep into the markets with me. Today, we're unpacking a lot of news from the latest market numbers to some major political developments that could shake things up in global trade. So grab your coffee, settle in, and let's get started.
Let's kick things off with a quick market overview. Our major indexes are showing a mixed picture this morning. The S&P 500 is trading at approximately 5,956, down by about negative 0.25%. The Dow Jones Industrial Average is somewhat lower as well, trailing around 43,433 with a decline of roughly negative 0.46%. Meanwhile, the Nasdaq Composite continues to edge lower, currently at around 19,075, with a drop of nearly negative 0.18%. And for those of you watching the smaller cap space, the Russell 2000 is sitting at about 2,174, down by a mild negative 0.06%.
Now, if you're into cryptocurrencies, you'll find some brighter news there. Bitcoin is currently trading at approximately 86,125, up by roughly 2.36%, while Ethereum is gently cruising at about 2,338, with an increase of nearly 0.26%. Quite a contrast, isn't it? We're seeing traditional equity markets showing early morning weakness, while digital assets seem to be flexing some strength. It makes you wonder if we're witnessing a shift in investor preferences or simply a reflection of the inherent volatility in these emerging markets.
Let's now move into a deeper exploration of the major market trends that are setting the tone for the day. It appears that the traditional market indices are grappling with some internal headwinds this morning. Many factors are at play here. Ongoing concerns about economic growth, inflation, and global trade uncertainties have all contributed to a slightly subdued trading session so far. One of the key storylines emerging is the heightened geopolitical tensions, most notably the new tariffs that are being proposed by none other than President Donald Trump.
In a series of repeated announcements, President Trump has indicated that tariffs on Mexico and Canada will begin on March 4, and on top of those, there will be an additional tariff of 10% imposed on China. There has been some noticeable confusion in these briefings, with one headline suggesting that the tariffs on our neighbors to the north and south might be delayed until April 2, only for President Trump to later clarify his original commitment to a March 4 start. This back and forth have sent ripples across markets, especially in sectors that rely heavily on international supply chains. It also raises questions about the stability of future trade policies. Investors are now left wondering whether this administrative acrobatics is a sign of deeper policy shifts or simply a reflection of last-minute tactical adjustments.
On the domestic front, another recurrent headline has caught the attention of the investment community: the issue of jobless claims. Reports are coming in that jobless claims have matched a 3-month high. While layoffs in the private sector have largely remained subdued, there is growing concern about potential federal job cuts, as hinted by sources close to the Trump White House. The mere possibility of more federal job cuts raises important questions about the overall health of the public sector and its subsequent impact on consumer spending and confidence. It's a debate that naturally extends into discussions on fiscal policy and economic stability, and one that we'll be keeping a close eye on in the days to come.
In addition to these policy headlines, we're also seeing positive signals from the durable goods sector. Core durable goods orders have risen for the third consecutive month in January by about 3.1%. However, a closer look reveals that this growth appears to be somewhat skewed by the performance of the transportation sector. While the data is certainly encouraging at first glance, analysts caution that not all industries are experiencing this robust growth uniformly. The implications here are nuanced. For sectors that benefit from rising consumer demand and robust industrial activity, this is a green flag. But for those that are deeply intertwined with slow-moving global trends, the underlying signals might not be as strong. It's a reminder that every economic statistic has layers of meaning. If I had a nickel for every time someone said, "Don't judge a book by its cover," I'd be reviewing investment strategies instead of books.
Now let's incorporate a broader coverage of critical stories during the headlines. We have a total of roughly 10 to 12 important narratives today, so let me walk you through them one by one.
First, the repeated announcement by President Trump regarding tariffs on Mexico and Canada starting on March 4, along with the additional 10% tariff on China, remains front and center. This story has been repeated multiple times across various outlets, underscoring its potential impact on international trade dynamics. Market participants are bracing for potential volatility in sectors such as manufacturing, technology, and agriculture that heavily depend on cross-border supply chains.
Second, an alternate story emerged recently with President Trump pledging another 10% tariff next week. Although there's some last-minute contradictions on whether the Mexico and Canada tariffs are set for March 4 or might be delayed until April 2, these mixed signals are creating an air of considerable uncertainty. And while little confusion in early morning political communication might be forgiven, the stakes in this case are high indeed.
Third, the employment story related to jobless claims continues to reverberate. We're seeing claims matching a 3-month high, spurring concerns about both job security and the overall public sector fiscal strategy. Remember, it's not just about the headline numbers, but the broader economic implications. Will we see a shift in consumer spending patterns? Are federal employees going to change their lunch choices because of these uncertainties? Only time will tell.
Fourth, on the positive side, core durable goods orders have shown a notable increase for a third straight month in January. Total durable orders were up by about 3.1%, albeit with transportation inflation playing a significant role. This is encouraging for investors in the industrial and manufacturing sectors, but it does raise the question, is this momentum sustainable, or are we simply riding a temporary gust of economic optimism?
Fifth, let's not forget to discuss the cryptocurrency market, which stands in contrast to the broader equity market trend this morning. With Bitcoin currently up by more than 2% and Ethereum logging a modest increase, it appears investors continue to see digital assets as a potential safe haven in times of fiat currency uncertainties. Whether this shift is indicative of a broader realignment across asset classes is a question that has been debated by many experts. Personally, I sometimes joke that Bitcoin should come with a warning label, invest at your own risk, and with a full shot of caffeine.
Sixth, while we focus a great deal on macroeconomic indicators and political decisions, the financial sector itself is under a microscope. Banks and finance companies are closely watching developments on the tariff front, as any shifts in trade policy can translate to currency risks and impact cross-border lending. For financial analysts and investors alike, these signals are crucial in gauging the stability of financial markets moving forward.
Seventh, the energy sector is also on our radar today. With global oil prices often sensitive to geopolitical tension, any shifts in tariffs and trade policies, particularly those affecting major partners like Canada and Mexico, could potentially disrupt the energy supply chain. While current data doesn't show dramatic shifts in energy prices, a lingering question remains: can the energy sector maintain its resilience if these trade tensions escalate?
Eighth, the technology sector is watching the trade policy news with a mixture of curiosity and caution. With supply chains often spanning continents and dependent on a free flow of components and raw materials, any disruption in trade relations could have ripple effects. For tech companies that source components globally, even a small tariff increase could have noticeable effects on cost structures and product pricing.
Ninth, global market implications are also brewing on the horizon. Beyond the U.S., international investors are keenly watching these developments. If tariffs are imposed and trade becomes more restricted, the spillover effects could be felt across Europe, Asia, and emerging markets. It reminds us that in today's interconnected world, no economy is an island. Are we witnessing the ripple effects of isolationist policies on the global stage? That is something worth pondering.
10th, and finally, the broader economic implications of these stories are significant. With policy uncertainty, fluctuating employment figures, modest industrial growth in durable orders, and a robust cryptocurrency sector, I'd say we are in the midst of a delicate balancing act. Investors are juggling diverse signals and attempting to piece together a coherent picture of both immediate risks and long-term opportunities.
Now let's transition into a detailed sector analysis, starting with technology, which is, as many of you already know, the bellwether of today's economy. With supply chain disruptions being a persistent risk due to potential new tariffs, tech companies that rely on just-in-time inventory models could see their costs rise. This is especially critical in a world where consumer demand for the latest gadgets and software updates is insatiable. Yet many tech companies compensate for these risks through efficiency improvements and diversified manufacturing locations. So while there might be some short-term pain, the long-term innovation trends remain robust. It is almost as if tech firms are reminding us we know how to debug problems, be they software errors or tariff errors.
In the energy sector, the story takes on a different tone. The definition of energy today is multifaceted. We're not just talking about oil and gas. Renewable energy projects are increasingly in the spotlight. However, if trade issues intensify, we could see disruptions in key components for solar panels, wind turbines, and other renewable technologies. The challenge here is ensuring supply chain integrity for these green technologies. On a lighter note, if the energy sector could keep up with these changes, they'd have enough buzzwords to power every conversation for years. Grid resilience, smart energy, sustainable yield. It's almost like trying to recite a marketing pitch at every oil change.
Moving over to finance, the interplay between global trade policy and domestic economic performance cannot be overstated. Banks and financial institutions are preparing for a potential tightening of credit as economic uncertainties grow. Should the tariffs impact cross-border financial flows, we might see adjustments in currency hedging strategies and international lending practices. The finance community is known for its cautious optimism. Every crisis, as they say, carries the seeds of opportunity. But let's be honest, when your portfolio looks like it's doing the cha-cha, it's hard to feel optimistic.
Meanwhile, in global market implications, trading floors across Europe and Asia are buzzing with cautious whispers. If the United States proceeds with these new tariff policies, and if the confusion around implementation persists, international trade could face increased friction. European manufacturers, for instance, are already grappling with the aftermath of Brexit, and additional uncertainties only compound the issue. Asian markets, particularly in manufacturing hubs like China and South Korea, might see shifts in demand patterns. There's a fundamental question here. In an era where geoeconomic strategies are as competitive as a three-legged race at a family picnic, how do companies hedge against such uncertainties?
I like to think of these developments as an intricate chess match, where every move, not just by the players on the board, but by the audience as well, has implications far beyond the immediate game. And speaking of games, it's hard not to laugh at some of the absurdity we sometimes witness. For instance, while policymakers debate tariffs in the boardrooms of Washington, somewhere out there, a mid-level manager in a tech company is frantically updating a spreadsheet titled Tariff Impact Analysis, a reminder that even the most high-level decisions trickle down to everyday work life.
Let's now talk expert insights and predictions. From our analysis over the past few days leading into this morning's briefing, several themes are emerging. First, the policy uncertainty around tariffs is something to monitor closely. Many of our veteran market players suggest that while immediate volatility is likely, a clear and consistent policy framework could eventually stabilize investor sentiment. However, if the ambiguity continues, as it seems to be right now, we may see prolonged periods of Gulf trading behavior, erratic swings followed by sudden rallies as investor confidence alternates between hope and caution.
Second, on the economic growth front, despite some mixed signals from durable goods orders and jobless claims, there is an undercurrent of resilience. Core economic indicators from the industrial sectors continue to show steady activity, even if growth appears uneven. This could be a sign that the overall economy, though buffeted by policy uncertainty, has structural strengths that might eventually allow it to weather these temporary headwinds.
Third, in the realm of cryptocurrencies, the slight uptick in both Bitcoin and Ethereum suggests that digital asset investors are enjoying a bout of optimism, or perhaps they're simply hedging against some of the traditional uncertainties. It's an intriguing juxtaposition. While traditional markets display early signs of weakness, digital assets are strutting ahead like the overachiever in a classroom full of sleepy students. Could this be a long-term structural shift, or simply another cyclical anomaly? That remains to be seen.
Finally, as we look at the broader global picture, expert consensus seems to favor caution over exuberance. Internationally, many analysts are calling for strong risk management practices. The reasoning is simple. In a world where one headline can trigger a domino effect from Wall Street to Tokyo, every investor would do well to double-check their stop-loss orders and maybe even invest in a good stress ball.
Now, I'd like to open the floor for some thought-provoking questions to you, our listeners. What do you think is the real impact of these fluctuating tariff policies on the global supply chain? How might the modest rise in durable goods orders translate into long-term industrial growth if the rest of the economic picture remains uncertain? And lastly, could the crypto sector's upward movement be hinting at a broader reallocation of investor capital towards non-traditional assets, or is it simply an aberration in an otherwise predictable market? I'd love to hear your insights and opinions on these questions, and please feel free to engage with our AI Copilot for deeper analysis.
Before we wrap up, let's do a quick sector-by-sector rundown, as this might help provide clarity for investors determining where their money is headed.
In technology, companies are on high alert regarding supply chains. Many are reevaluating their sourcing strategies in anticipation of possible higher costs due to new tariffs. This has spurred additional investment in research and development aimed at fostering greater self-reliance. Yes, even giants in Silicon Valley are dusting off their Made in the USA tags in certain components. There's a delicate dance at work here, balancing global efficiencies with national security concerns.
In the energy space, the focus is split between traditional fossil fuels and the rapidly growing renewable energy segment. Analysts are keeping a close eye on not just the pricing, but also the geopolitical ramifications. If tariffs disrupt parts of the global supply for renewable energy components, we might see a temporary setback in some green projects, but historically resilient energy markets tend to bounce back faster than a pop star's comeback tour. Perhaps we'll see the energy sector reinvent itself yet again. Maybe next, they'll power your home using a combination of solar energy and carefully calibrated tariff adjustments.
When it comes to the financial sector, the emphasis is on risk management and liquidity. Institutions are already reassessing their exposure to international markets, especially as uncertainty around trade policies persists. Banks, in particular, are recalibrating their lending practices to account for potential fluctuations in consumer spending and currency exchange rates. For many of you with diversified portfolios, this might be a call to review your risk management strategies and perhaps even consider rebalancing your asset allocations.
Global market implications extend beyond our immediate national boundaries. European investors, for example, are already bracing for potential spillover effects from any escalations in U.S. trade policy. In Asia, especially in countries like China and South Korea, where manufacturing plays a crucial role in the economy, any uptick in tariffs could force companies to adjust their global strategies. It's these interconnected relationships that make the global economic forecast as challenging to map as trying to predict the plot twists in a well-seasoned political drama.
In wrapping up our detailed discussion for today, I'd like to share some expert insights and personal predictions. It's clear that the immediate outlook is one of cautious optimism mixed with a fair share of uncertainty. As headline makers like President Trump continue to shuffle his tariff declarations, and as jobless claims hint at underlying uncertainties in the labor market, investors need to remain nimble. The key takeaway is to stay informed, diversify your holdings, and don't be blindsided by sudden shifts. Markets, much like life, have a way of surprising us when we least expect it.
As you go through your day, here are some final thought-provoking questions to mull over. How will sustained policy uncertainty impact long-term investment strategies? Are we seeing the beginnings of a structural rebalancing away from traditional equities toward alternative assets like cryptocurrencies? And what lessons can we draw from the current situation that might help us prepare for future economic cycles? I encourage you all to share your thoughts, discuss with peers, and of course, engage with our Pantheon AI Information Copilot for further analysis.
Thank you for joining me on this deep dive into the markets and the news stories shaping today's financial landscape. I appreciate your time and thoughtful engagement as we navigated through everything from the minor dips in our major indices to the complex narratives emerging around tariffs and jobless claims. Remember, every piece of data, every headline, and every nuance holds a lesson for the savvy investor.
This has been an insightful journey, and I hope you walked away with a clearer picture of today's market dynamics. I want to give a big shout out to Pantheon AI for being your ultimate information co-pilot. Our goal is to make sure that learning doesn't feel like a full-time job. And if there's one thing I've learned from decades of discussing markets, it's that sometimes a little humor and a curious mind can go a long way in making sense of this wonderfully complex world.
So as we conclude today's briefing, I urge you to stay engaged, ask those big questions, and don't shy away from challenging your own assumptions. Come back tomorrow for our next episode where we'll dive even deeper into emerging trends, discuss new breakthroughs, and of course try to have a few laughs along the way. Until then, keep your strategies sharp, your questions pointed, and remember, you can always ask our AI Copilot for a deeper dive into any topic.
Thank you again for joining me on the PAI Morning Briefing. Have a great day, and I look forward to catching up with all of you tomorrow. Learning shouldn't feel like a full-time job.